Ladies and gentlemen, listen carefully because if you currently own something like 500 Oz of silver, you need to understand that your position is no longer sitting quietly on the sidelines of the financial system. What you hold is now directly connected to a structural transition that is beginning to spread underneath the surface of global markets. I am not talking about a temporary rally. I am not talking about a short term price spike that disappears within weeks. I'm talking about a much larger shift in the foundations supporting debt, currency stability, investor confidence, and capital allocation itself. Most people still do not see it because they are trained to focus only on visible events. They wait for headlines. They wait for official confirmation. They wait for institutions to explain what is already happening after the move has started. But history has proven this again and again. The largest transitions never begin with public clarity. They begin quietly while the majority still believes the old system remains intact. And right now, silver is beginning to reflect exactly that type of transition. Most investors still think about silver in the wrong framework. They view it as a passive hedge, something defensive that sits in the background while equities drive wealth creation and central banks maintain stability. But that assumption depends entirely on confidence remaining strong inside the broader financial structure. Once confidence begins weakening, the role of silver changes completely. This is the part most people fail to understand. The real importance of silver is not the metal itself. The real importance is what ownership represents during periods when the financial system begins showing signs of stress, because when trust in monetary system starts eroding, capital does not behave the same way it behaved during expansionary cycles. Investors begin searching for assets that exist outside the promises supporting the system itself. That process is already started. You need to understand what is happening beneath the surface because most people are completely blind to the scale of imbalance that has been building for years. Governments expanded debt continuously under the assumption that low interest rates would remain permanent. Corporations borrowed aggressively because refinancing remained cheap and accessible. Consumers relied on credit expansion to maintain purchasing power while asset prices inflated across nearly every sector. For a long time, this environment appeared stable because liquidity covered the underlying weakness, but liquidity can distort reality for only so long. Eventually, debt reaches a scale where the system requires constant intervention simply to maintain equilibrium. And once that stage is reached, fragility begins spreading quietly underneath the surface, even while markets continue appearing functional. This is not speculation. This is structural mathematics. Debt behaves very differently when interest rates rise. What once looked manageable suddenly becomes restrictive. Governments face expanding servicing costs, corporations lose flexibility, consumers reduce spending capacity. Entire sectors that relied on cheap money begin slowing simultaneously. And when enough pressure builds across interconnected systems, confidence starts weakening gradually. Not all at once, not through immediate collapse, but through behavioral change. Investors become more defensive, institutions begin reallocating quietly. Capital starts searching for protection before instability becomes visible to the public. Silver sits directly inside that transition. For years, silver remained ignored because markets rewarded risk-taking behavior elsewhere. Equities surged higher, technology absorbed enormous capital inflows. Speculative assets outperformed. Investors became conditioned to believe that monetary expansion would continue indefinitely without consequence. In that environment, silver appeared irrelevant because stability itself became the dominant assumption, but markets do not remain permanently stable. Every cycle eventually creates imbalance large enough to force adjustment. And when adjustment begins, neglected assets suddenly become important again. This is exactly what happened repeatedly throughout financial history. The majority always believes the current cycle can continue longer than reality allows. They believe central banks can maintain stability indefinitely. They believe debt expansion can continue without creating pressure inside the monetary system. They believe liquidity solves structural problems permanently. But liquidity does not eliminate imbalance. It delays recognition of imbalance until the pressure becomes too large to ignore. Then, suddenly the narrative changes. Confidence weakens, volatility increases, capital rotates aggressively, and assets that spent years ignored begin repricing far faster than most participants expect. Silver has entered that stage before, and the conditions forming today are beginning to resemble those earlier transitions in extremely important ways. Now, listen carefully, because this is where most investors lose perspective. They assume silver moves only because of inflation headlines or temporary fear. That interpretation is incomplete. Silver responds to much deeper forces. It responds to confidence shifts inside the monetary structure itself. It responds to debt pressure. It responds to declining trust in policy management. It responds to instability inside systems dependent on continuous expansion. And what makes silver unique is that it operates simultaneously as both a monetary asset and an industrial necessity. Very few assets exist at the intersection of those two forces. That matters far more than most people realize. Industrial demand alone has already becoming increasingly important. Global infrastructure expansion continues accelerating. Electrification systems require massive material inputs. Solar energy, electric vehicles, telecommunication infrastructure, medical technology, advanced computing systems, data centers, and defense applications all require silver because of its conductivity and efficiency. This demand is not based on speculation. It is based on necessity. Modern technological systems require silver that are extremely difficult to replace at scale. At the same time, supply growth remains constrained. Mining expansion is slow, expensive, politically difficult, and heavily regulated. New discoveries remain limited. Operational costs continue increasing. Environmental restrictions delay development timelines. And most importantly, much of the global silver supply is produced as a byproduct of mining other metals, meaning production cannot easily accelerate in direct response to rising silver demand alone. That creates structural pressure inside the market, because when demand rises steadily while supply remains constrained and balance begins accumulating beneath the surface, whether investors recognize it immediately or not. And eventually, markets reprice imbalance not smoothly, not comfortably, and never in a way that feels emotionally easy while it is happening. That is why most investors fail during transitions like this. They expect clarity before acting. They expect consensus before positioning. They wait for reassurance from institutions and analysts before accepting that conditions are changing. But by the time consensus fully forms, the largest portion of the move is often already underway. Early stages always feel uncertain. They create conflicting narratives. They produce volatility that shakes conviction. But volatility during transition is not necessarily weakness. Very often, it is evidence that the system itself is beginning to adjust to a different equilibrium. And this adjustment is already started. Stop. You need to understand something most investors never fully grasp until it is too late. Financial systems do not break all at once. They weaken in layers. First, confidence erodes quietly beneath the surface. Then liquidity conditions tighten gradually. Then capital begins repositioning before the broader public even recognizes that a transition has begun. By the time headlines finally acknowledge the problem, the adjustment is already well underway. This is why the smart money always appears early. Institutions do not wait for certainty. They move when structural conditions begin shifting underneath the market itself. And those structural conditions are shifting right now. Look at what is happening globally. Debt continues expanding at a pace that requires constant intervention to remain manageable. Governments cannot reduce spending without slowing growth. Central banks cannot tighten aggressively without increasing pressure across leveraged sectors. Corporations remain dependent on refinancing. Consumers continue facing declining purchasing power as inflation quietly reshapes everyday costs. The system has become trapped between competing pressures that cannot easily be resolved. If policymakers tighten conditions too aggressively, instability spreads through debt markets and credit systems. If they loosen conditions again, currencies weaken and inflation pressure accelerates further. This is a tension forming underneath everything. Most people still assume central banks retain complete control over outcomes because that assumption defined the last cycle. Markets became conditioned to believe policymakers could stabilize volatility indefinitely through liquidity injections and accommodative policy. But systems built on expanding debt eventually reach a point where intervention itself creates new forms of instability. Every solution introduces additional consequences. Every round of liquidity weakens confidence in long-term currency stability. Every tightening cycle exposes hidden fragility created during years of easy money. This is why the current environment feels increasingly unstable, even when official narratives attempt to project confidence, because beneath the surface confidence is already being tested. And when confidence weakens, investor behavior changes. This is where silver becomes increasingly important, not because of hype, not because of temporary momentum, but because silver exists outside the mechanisms requiring institutional trust to function. It does not depend on central bank credibility. It does not rely on policy promises. It does not require confidence in government balance sheets to maintain its existence. Physical scarcity gives it intrinsic positioning inside periods of monetary uncertainty. That distinction becomes extremely important once investors begin questioning the durability of the broader system supporting financial assets. Most investors are still focused on short-term market noise. They are watching daily fluctuations in equities. They're reacting to economic report, employment numbers, inflation releases, and interest rate expectations. But these short-term data points distract from the deeper structural issue forming underneath the entire global system. The foundation supporting decades of debt expansion is beginning to experience pressure from multiple directions simultaneously. And when foundations weaken, capital eventually seeks protection outside the structures, introducing risk. History follows this pattern repeatedly. Periods of excessive expansion always create imbalances large enough to require eventual correction. During expansionary cycles, leverage increases because stability appears permanent. Risk taking accelerates because liquidity remains abundant. Investors stop questioning assumptions because rising asset prices reinforce confidence. Right. But no debt driven cycle expands forever without consequence. Eventually, the burden of maintaining the system becomes larger than the system itself can comfortably support. Right. That is when volatility begins spreading through markets in ways policymakers struggle to contain cleanly. This never ends quietly. And when these transitions unfold, right, precious metals begin attracting renewed attention, not because investors suddenly become emotional, right, but because they begin reassessing what actually preserves value during periods of structural stress. Like silver becomes especially important because it benefits from both monetary uncertainty and industrial necessity simultaneously. That combination is rare. Right? Most assets respond primarily to one force or the other. Silver operates in both dynamics at the same time. Think carefully about what that means. If economic uncertainty increases, right, monetary demand for silver rises because investors seek alternatives outside traditional financial structures. But even if industrial expansion slows temporarily, right, the long term infrastructure transformation already underway globally continues, requiring enormous quantities of silver. Electrification, energy systems, advanced manufacturing, right, digital infrastructure, tech communications, and technological development all continue expanding over multi decade timelines. Silver remains deeply embedded within that process. Right? This creates a powerful structural foundation beneath demand. At the same time, the silver market itself remains extremely small relative to global capital flows. Right? That is a critical detail most investors underestimate. Global bond markets represent hundreds of trillions of dollars. Equity markets operate at enormous scale. Right? Institutional capital constantly reallocates between sectors searching for protection, yield, and stability. Silver, by comparison, is tiny, right, which means it does not require a massive shift in investor behavior to produce major price movement. Right. Even a relatively small reallocation of global capital toward precious metals can create disproportionate impact because supply remains constrained while available physical inventory is limited. Right. That is why silver historically does not move gradually once momentum develops. It remains ignored for long periods while pressure builds quietly underneath the market. Then suddenly attention returns, institutions increase exposure, retail participation accelerates, narratives shift rapidly from dismissal to recognition. And because the market is relatively small, right, repricing occurs aggressively rather than slowly. Investors who waited for reassurance find themselves reacting emotionally after the move is already underway. Right? This cycle repeats constantly throughout financial history. First comes neglect, then accumulation, then recognition, then repricing. Right? And the early stages always feel uncertain because uncertainty itself is what prevents the majority from positioning before the transition becomes obvious. Most investors require validation from consensus before acting. They want certainty. They want headlines confirming the move. They want institutional approval before accepting that conditions have changed. But markets reward positioning before certainty appears, not after. That is why conviction matters during periods like this. If you own $500 of silver, you need to recognize that your position now represents exposure to multiple converging forces simultaneously. Monetary instability, debt pressure, industrial expansion, supply constraints, capital rotation. These forces are not isolated, they reinforce one another. And when multiple forces begin aligning around the same asset class, the resulting adjustment rarely remains subtle. This is not about predicting an exact price target. The obsession with specific numbers causes investors to miss the much larger point. What matters is not a precise forecast. What matters is recognizing the direction of the broader transition underway. Because once capital begins moving consistently toward assets perceived as monetary protection, that movement tends to persist longer and accelerate faster than most participants initially expect. But you also need to understand the psychological side of this process, because this is where most people fail. Volatility will increase, sharp moves higher will be followed by reversals. Analysts will disagree publicly, narratives will conflict. Financial media will create confusion because uncertainty generates attention. During these phases, conviction becomes extremely difficult to maintain for participants who do not understand the deeper structure driving the movement. This is how wealth transfers occur during major transitions, not because information is hidden, but because emotional pressure causes most participants to abandon positions before the cycle fully develops. Those who understand the structure behave differently. They recognize volatility as part of transition rather than evidence the thesis has failed. They understand that large financial adjustments never unfold in perfectly smooth pattern. They know that capital relocations occur in waves, and they accept that discomfort is part of positioning early before the broader market fully recognizes the shift underway. Right now, most investors are still underestimating how significant this transition could become. Stop. What you are witnessing now is not simply another market cycle repeating in isolation. This is a broader transition connected to how value itself is being reassessed across the global financial system. And you need to pay attention because once these shifts accelerate, they move far faster than the majority expects. Most people believe they will have plenty of time to react later. They assume major transitions announce themselves clearly before the consequences fully arrive, but that has never been how structural change unfolds. By the time the average investor feels confident enough to act, the largest advantages of early positioning have already disappeared. This is why understanding matters more than prediction. The majority keeps searching for certainty because certainty feels emotionally comfortable. They want economists to agree. They want central banks to sound confident. They want financial media to validate the transition before accepting the conditions are changing underneath the system. But real transitions never feel fully certain in real time. They feel unstable. They feel incomplete. They create conflicting narratives that make conviction difficult, precisely because the market itself is adjusting from one equilibrium to another. Silver reflects that process directly. For years, the market treated silver primarily as a forgotten commodity. Capital flowed elsewhere because growth assets dominated attention. Investors became conditioned to believe technological expansion and monetary support could sustain endless appreciation across financial markets without consequence. But systems dependent on continuous debt expansion eventually encounter limitations. Confidence begins weakening at the edges first, then pressure spreads gradually across larger portions of the system. And when investors begin recognizing those pressures, capital starts repositioning toward assets capable of operating independently from the structures introducing risk. This is where silver becomes critical again, not because of emotional fear, not because of temporary speculation, but because silver represents something fundamentally different from traditional financial assets. Stocks depend on growth expectations. Bonds depend on confidence in debt repayment and monetary stability. Currencies depend on trust in policymakers and governments maintaining purchasing power over time. But silver exists outside those promises. It is tangible, it is limited, it cannot be created through policy decisions or monetary expansion. That independence becomes increasingly valuable once confidence inside the broader system begins weakening, and confidence is weakening. You can already see signs of it forming beneath the surface. Governments continue relying on deficit spending because reducing debt expansion would slow economic activity too aggressively. Central banks remain trapped between inflation PR